Hi everyone, and welcome back to the channel. Thanks for joining me here today, where today I want to talk to you about what age you should be when you start investing. Wouldn't that be great if someone could give you the age where you should start? Um, some of you might know the answer already, but let me get into it and show you the various levers that Monish Pabrai taught me about. Um, I want to start by showing you a chart. I'm just going to put a chart up here of the major stock index in America, the Dow Jones Industrial Average, over a 110-year period. The Nasdaq, and I don't have data for the Nasdaq and the S&P back that far that you know augment this amount of detail. But as you can see from this chart, plenty of bad stuff can happen in a time frame like this. And this is exactly what this chart shows. Every point, every number on that chart indicates a major, fearful, emotional event. You could always come up with a reason not to start investing. And there are many ways to start investing. And I can almost guarantee you that the way you start will not be the way you finish. But one should start investing as soon as they can. Now, I want to start early by saying that when I say just start as early as you can, I don't just mean stop the video right now and go out and plow your money into whatever you currently think investing is. Some people think that investing is buying Tesla at a $1 trillion valuation, or buying Bitcoin, or investing in low PE stocks, or day trading, or index investing. Now, I'm not saying that some of these examples cannot end up being good investments or they cannot end up making the investor money, but it's not the kind of investing that we're going to be uncovering together on this channel. Mainly because if they are ways to make money, I don't know how to implement them. So I'm certainly not going to be trying to talk to you about and share with you what I've learned about them because I don't know how to implement them. I try to stick within my circle of competence and focus on Warren Buffett style value investing that I can wrap my head around, where the number one rule is don't lose money. So you focus on your downside, and the upside takes care of itself. Um, there are many investing methods out there that are not actually investing, but are more speculation, and they can be the path to financial destruction instead of financial freedom, which is what we're aiming to achieve: financial freedom, not financial destruction. Time can sometimes be the cure to a bad investing strategy, however, but not always. If you buy Bitcoin at really high valuations, whatever that is, if you can even quantify that, you may be able to hold it for 30 years and actually end up, making money, for example. I don't know. But some people don't have that long. So time is not always the answer to a bad investing strategy, just holding on. So what is this guy telling me? What am I telling you? First, he puts a chart up showing that stocks only go up and to the right. And then he's saying I shouldn't go out there and buy stocks. So finding a method that works for you and has proven to work for others in the long term and starting early is what I mean by you should start investing as soon as you can. And you'll hear me talk about Warren Buffett a lot because his track record in value investing is undeniable. This chart here again showing returns from major billionaire investors, and Warren Buffett is just untouchable over there, far to the right. He's been investing for decades and decades, and for someone who's been investing through decades and decades and who's been investing through all those emotional events, and to have that kind of outperformance above the S&P 500, it's certainly undeniable in my opinion, and we can learn from him. He does everything to teach us. You just have to want to learn. He doesn't give classes or sell us any courses, but he's been talking in his annual meetings and writing shareholder letters for decades and decades, year after year. And you can also learn from what he does as well as what he says. Check out my videos about cloning investors using 13F season for more information on that. Um, I've been investing for my son since he was born. I opened a tax advantaged account for him when he was born, and he's already 5 years into his compounding journey. And Warren Buffett started when he was very young as well. He bought his first shares in a public company in the 40s, I think, around $200 at the age of 11. Um, and around that time, he swore he was going to be a millionaire by the age of 30. Now, it's actually not that hard to imagine when you do the maths. We know that Warren Buffett, from what he said, was earning $170 a month from selling newspapers around by age 15. And in his early compounding years, his rates of return were way higher than 30%. But if we assume a constant, say, $175 a month savings and a 30% compound annual growth rate, we get to a million from $228 in 30 years. Now, the reality of it was that he had a lot more to save towards investing per month as time went on. And from the age of 15, or even the age of 11, he was reading lots of books. He was reading lots of books in the Omaha Public Library, and his learning went through the roof. And the additional cash that he can put towards his investing only fuels that fire of the compounding machine. So start young as you can. Even if your child has just been born, you can start that compounding journey for them. Monish Pabrai talks about 3 things that we can control to grow our wealth with investing. The first one is the starting amount. Okay. The second one is the rate of return that you could achieve. And then the third one is the length of the runway. How long do you have before you stop investing or before you die? How much time do you have to invest that money at that rate of return, that starting amount at the rate of return? So the starting amount will differ widely by the individual, depending on your financial standing and your age, and when you first discover this video. The rate of return is normally what we have the most control over, and we're adopting a value investing approach and learning from Warren Buffett and Charlie Munger can blast those rates of return well past the historical index average of 8 to 10% per annum. And the length of the runway, which is more in line with what this video is about, is something that is determined by when you decide to start. So I just want to show you some examples in a more visual way. So I've got some columns here, and each column affects each column is a different rate of return. So essentially, I've got 3 things here. I've got the starting capital, the rate of return, and then the length of the runway. And we can run these columns and see what we end up with after different timeframes, depending on the starting capital and the rate of return. So let's assume in a cash savings account that we can achieve 2%. Our initial starting 10 grand, if we don't have any other monthly savings, grows and it grows, and it grows to, after 40 years, it just over doubles. Now that's not ideal. Doubling every 40 years, that really is not what you want to achieve. And we haven't factored in inflation here. And inflation does exist. It will always exist in some forms. Economies like to achieve a low level of inflation, so you might get deflation at some points, but mainly throughout your lives there'll be some sort of inflation. So if we assume, say, 3%, we're actually going down. We're actually going backwards because our 2% rate of growth is not enough to keep up with inflation. So our money's going down, guys, and inflation is eating away at it. So saving in a cash, just keeping it in cash and maybe getting 2% back on your money it's not going to cut it. Basically, you're losing money right out of the gate. So let's turn on the 10% rate of return. And 10% rate of return is there to kind of mimic what an index would give you, like the S&P 500. So turning on the 10%, now we're talking. So even with inflation, we're starting to see that upward slope. So we started 10 grand, and after 10 years, we've doubled nearly. So it's only taken 10 years as opposed to 40 years. After 20, we've got a triple, and then after 30 years, we've got 7x. And then after 40 years, we've turned that $10,000 into 133. So that's great. That's good. And then obviously, if we can save £100 a month and increase that monthly by every year, increase those monthly savings by say 5%. If we turn that on as well, we can further boost that machine. So with that off, after 40 years, we're at 133 down here, 133,000, and turning on those monthly savings just feeds the compounding machine that much more. We're over 500,000 basically, and that's assuming that you can passively invest into index funds. So with the value investing that I practice and that I'm trying to share with you guys, we aim for a minimum acceptable rate of return of 15%. And then what we do is whatever price that we have to pay to get that 15%, we then take a 50% margin of safety off of that. And then we aim to buy at 50% lower. So hoping that we will, as a bare minimum, achieve 15%. And then what that 50% margin of safety actually equates to is a 23% rate of return, if we can achieve that. 23.25% really. But so turning on the 15%, which is the minimum that we want to get, now we're seeing that hockey stick effect on the graph. It's taking less and less time to double. 10 grand, we've doubled in 4 years here. Okay. It's taken 4 years to double, as opposed to with our 2%, it's taken 10 years to double. Sorry, this is with the savings on now. We're always factoring in inflation because that's constantly eating away at us. And then at the end of 40 years, so if you invest in your 30s and you're investing into your 70s, if your 30s is when you start, then we've got 2 million, and that's taking into account inflation. If inflation didn't exist, okay, yes, we'd have at the end of 40 years we'd have $5.8 million, but we wouldn't really, because our buying power is being eroded over time. So if we factor in inflation, that's a $2 million equivalent in today's money that we'd have in 40 years, which is nothing to turn your nose up at. And maybe we have a much larger starting capital. Maybe we've got 100k to start with. It depends on how you can pull these levers: the rate of return, the starting capital, and the length of the runway to your favor. And working on all three. And obviously, what we ideally, that's the minimum that we want to achieve. And I'm going to have to change the scale on this graph, because when I click this button, and if we ever achieve the 23%, which we're aiming for, it's an exponential curve. I mean, these lines down here, this 10% line starts to look a bit flat. We can barely see it down the bottom there. So maybe a logarithmic scale where the increments are uneven is more appropriate there. And then we can still see all the lines, but turning the log scale off really shows you that hockey stick effect. And guys, after it's taken us 3 years to double, okay, which is not much different to the 4 years it took to double with the 15%. So is there that much difference? 3 years to double and 4 years to double? Well, yes, there is, because compounding is on top of itself. Compounding on last year's money compounds on the year before that and the year before that. And as we go out after 10 years, we've doubled in the 15% example 5 times. Oh, look, in the 23% example, we're 4 times more than that. We've doubled 9 times. And after 40 years, and this is with inflation, guys, with 3% inflation, we got $21 million. And that's starting at $10,000 starting point, and saving £100 a month. $100 a month. So I keep talking in pounds. I'm from the UK. So So yeah, hopefully that kind of helps you visualize the power of compounding, obviously, compound 26, um, and how each of the levers of that I'm talking about can be pulled to affect that rate of return. And of course, you can do very well. Um, column F here shows the 10% rate of return, which is if you invest in an index, you can do very well at that. You just have to wait longer, and you will not be achieving, the the large sums of money when at the end of your investing journey. But that's when the length of the runway becomes more important, more of a determining factor when your rates of return are a bit lower. As I've mentioned in previous videos, value investing is not easy. It's simple, but it's not easy. But value investing is not the only way to go, of course. One can be a passive investor and invest in indexes, and you can do very well with that kind of approach. The length of time to reach your financial goals will be elongated, but at least you've started that compounding machine, that compounding engine. It may be a modest horsepower engine, but even the most modest of engines, with the power of compounding, can get you to your destination eventually. With this approach, the length of the runway then becomes the dominating factor in determining the time taken to reach your financial goal. It's not the rate of return so much, because that's not fixed, but you don't have as much control over it, because you don't have any control over it, because you're investing in the market, in the indexes, and whatever the rate of return of the market is, that's going to be your rate of return. But the length of the runway is what will be a dominating factor there. Plus, you must have a mindset to be a passive investor if you're going to do that. More of which I cover in my other videos about passive versus active investing. That also has its difficulties, despite the word passive implying automation or kind of lack of involvement. So basically, the idea, the triple whammy, the triple punch. The idea is to maximize all three of those areas that I mentioned. So allocating any long-term money that you do not need for the next 5 to 10 years to investing, and live within your means and save as much as you can towards your investing account. Start down the journey of value investing, and if it pulls you in, let it pull you in. Once understood, it is a fantastic way to achieve market-beating returns and outpacing the stock indexes and inflation. If we don't even outpace inflation, well, then we're just going backwards, really. And then starting investing early. The mistakes you make as an early investor, even when you start early, you're bound to make mistakes. But those mistakes, they're not fatal, and they're not the end of the road. And they can be some of the best and most profitable mistakes that you will ever make. Think of them as more of a tuition fee. And the earlier you make mistakes, the better, because the more time you have after the mistake to not only learn from it, but recover from it. You might make a mistake with your entire portfolio, God forbid, that you lose everything. But because you're starting early, your entire portfolio of long-term money might be a few months of your paycheck. So it won't take you that long to get back on track. But you can't start learning and making mistakes and learning from those mistakes if you never actually start. So put some money towards investing in indexes, or some, having skin in the game. That's when you really feel the emotions. That's when you can control your emotions. Try and make them not become part of the equation. That's when you really start to learn what on earth it is that you've got your money in. So start investing early, and don't be afraid to make mistakes and learn from those mistakes. So how old should you be when you start investing? Well, there's obviously no age to start investing. Anyone can do it, especially these days when the friction to do so is so low. But you must invest with your head screwed on and understand the methods that you are employing. I and the rest of the value investing community have learned from the most successful investors in the world, such as Warren Buffett and Charlie Munger, and many others, Monish Pabrai, Guy Spear, Howard Marks, lots of different investors out there. Matthew Peterson, another great one. If value investing is not for you, and the only thing that you take away from this video is the effects of inflation, and that something in your financial life needs to change, then yeah, making this video has been wholly worth it. And please give a like and subscribe below if you have enjoyed this video. Even if you don't have all of the three that I mentioned, even if value investing doesn't grab you by the balls and drag you into this world that you love like it has with me, you can still lengthen your runway and invest as much as you can in a passive way, in a sensible passive way, and only use long-term money that you can afford to do without for 5 to 10 years. And even then, you can't really go too wrong. And it's something that Warren Buffett actually recommends himself for people who don't know how to invest like him or to practice value investing principles. But if you latch on to what I'm telling you and you're keen to learn more about value investing, then definitely, like I said, smash that like button and subscribe, because there's more videos coming on this channel and on this journey that we're going through together. So yeah, subscribe to this channel for more videos. I'll be going through many more principles of value investing in the future, maybe covering some individual stock investments as well. So with that said, I'll let you get back to your day, and let's all go out there and become super investors together. Thank you so much for watching, you guys and gals, and I'll catch you on the next one. Take care.